I would like to welcome everyone to today's webinar, our first as Global X Canada. The topic today is we wanted to provide some opportunities that you might look for diversification and income. Why would we be talking about this today? It looks like there could be a potential shift in investment style right now. There's been a bit of a shift off of the growth and into the value. We've had a couple days with pretty big differences in the markets between the NASDAQ and the Dow. Looks like money's moving a little bit more international, looking for value opportunities. So we thought this was an opportune time to talk about diversification and income opportunities. And of course, income's always a hot topic, and looking for yield and where you can look for that yield. Today, the Bank of Canada just cut by another 25 basis points. So looking at trying to capture some of that yield while still participate in some potential upside. So we're going to position a couple of ideas for your consideration in the international markets and in government bonds, a couple of housekeeping topics. And we're hoping to get through our presentation in about 30 minutes or so. If you do have questions throughout, please feel free to enter them up in the question. There's a toolbar in your top right corner, and there's one with a question mark. You can enter a question throughout the presentation, and I will do my best to answer that either during or after the presentation. And if we can't get to all of them, we will do our best to reach out to you afterwards. Now, right beside that icon is another one with a paperclip. That's a documents task. You can download some documents that have some information on the solutions we're talking about today. Includes our complete product lineup, our Pay Series one-pager, as well as some product sheets for some other products. And our agenda today. And my name is Jeff Lusick. I'm the head of the sales team here at Global X Canada, so I'll be your host for today. I look similar, maybe a little bit more gray hair now. And I'm fortunate enough to be joined by Vern Roberts. I call Vern the most interesting man in the world, or at least the most interesting man at Global X Canada. All of the letters there behind under his name, most notably an MBA from the University of Oxford, which is quite impressive, along with a CFA and a CMT. So the perfect person to be talking with us today on value opportunities, international markets, yield curves, opportunities in fixed income, options, etc. Just a quick overview on MPAY Asset Financial Group. Global X Canada is part of MPAY Asset Management, which is a very large global asset manager with about 800 billion in assets under management. We've got a lot of assets around the world, traditional assets, mutual funds, SMAs, ETFs, a lot of alternative investments, including properties, private equity, etc. We are part of their global ETF platform, mostly branded as Global X. And that global ETF platform has approximately over 150 billion in assets under management. So we're part of a large global entity. And that level of assets puts us near the top 10 globally for ETF providers. So part of a large global organization, we like to call it part of having that global strength, but maintaining our local expertise here in Canada. As we were born and grew in Canada, we still maintain that innovation that we're known for here in Canada. And on that, we've continued growth with the support and partnership with our clients, such as yourself, and we do appreciate that. We've had a lot of growth over the years. Last year, we had a record year in net positive sales. And as of now, we're at around 34.5 billion, nearing in the end of July. That run across 125 different ETFs. We have a tagline, we have an ETF for that. We want to be known as a core provider to you for core exposures, explore exposures, income, thematic. So make sure you're looking to Global X Canada or reaching out to your sales team or to info@globalx.ca if you have any questions or if you're looking for any unique opportunities. So Vern is our options strategist and wants to talk about some covered calls. So, the focus today is on our options-based ETFs, helping to provide more income with the exposures that you're looking for and knowing what you own, but being able to generate some more income from that. So Vern, I'm going to pass that over to you.
All righty, go to the next slide. You can see our covered call business here at Global X Canada, as of the end of June, was about 1.8 billion. We are, as of today, about 50 short of 2 billion in assets, continuing to get nearly about 100 million a month in new assets in this covered call space. On the next slide, I'll highlight sort of our core group of covered calls. They're split between sector and index. At the top of this slide, you see we have covered calls for banks, energy, gold, and gold bullion, which is a HGY that generates yield. And then below that, you see we have the TSX 60, the NASDAQ 100, and the S&P 500. These are all covered call funds that own either the index or the underlying stocks, in the case of the sectors, and then we sell calls to generate additional income.
Yeah, and on this slide, Vern, I'll note that you're seeing some of those core exposures of the geographies, the TSX 60, NASDAQ, the S&P 500, as well as the equal weight banks, as a very low fee of 0.39%. And if we're not the lowest, we're amongst the lowest fees in the covered call space in the Canadian industry for those exposures. And of course, you see the attractive yields on the right that they're offering with 6 of the 7 in the 10% plus range of yield, which can also be tax efficient, which we'll touch on.
Exactly. And, as a high level introduction, most people consider these funds because A, they generate monthly income. B, you get a chance for capital appreciation in addition to this income. C, the active option program that generates the income doesn't cap earnings as much as a more aggressive covered call program that sells at the money options. And C, the distributions are tax efficient as they're treated as capital gains.
So I just wanted to give you a preview of what we like to call our equity essentials lineup. We're the only non-bank, true independent provider that provides access and investors the ability to invest in all of these premier, well-known indices, ranging from the TSX 60, equal weight banks, S&P 500, NASDAQ 100, MSCI, EAFE, and MSCI Emerging Markets. But we're also able to provide the most ways you can invest in all of these indices. So on the left, you see the core exposure. That's the traditional low-cost benchmark exposure that you would be familiar with. On the next column over, it's the covered call lineup. So for those looking for more income, you can be invested in those well-known indices, but generate a little extra income from them for your income needs. Now we even take it a step further. The third column, lightly levered, this is for more of that growth potential. You like that core exposure of that geographic index, but you're looking for a little bit more upside. We're able to provide that with a little extra enhanced leverage, up to 25% cash margin, and in this way, you don't have to use margin in your accounts, and it's a lot more cost-effective way to have that extra exposure. And then the last column is levered and covered calls, able to provide you a little bit more growth and income if that's what you're looking for and have the time, the risk parameters and the time horizon for it. So one of the only providers that can provide you all of these ways to access these indices and the most ways that you can invest in them. And the beauty of this is, depending on where you are in your investment life cycle, you can either be invested in it just for the pure growth or for the income, but yet you know what you own on the underlying. And for the advisors that are tuning in, you can have your core exposure for certain clients that don't need income, and then you can have a covered call version generating more income for those clients that do need it, but yet you still have the same consistency of what you're invested in across your portfolios, and you understand what you own and you know what you own. So that's a large benefit for us that we're providing to our investors. So, and what we're introducing today, we went through our covered call lineup. Vern took us through the 7 previously, but we're introducing today as part of our new launches that we're now offering covered calls on the MSCI EAFE, which is international developed markets. That includes Europe, Australasia, and the Far East. That's the EAFE acronym. And the Far East, it would include Japan and Singapore. So that's your way to access and invest in the international developed markets, but yet receive some extra income from being invested there and provide a little bit of less volatility, ideally a little more downside protection, but receive a nice tax efficient yield and be invested in the MSCI EAFE. So that is EACC. And the other one to provide, again, even more diversification is the MSCI Emerging Markets, EMCC. And that's providing you access to the emerging markets, but again, providing you some extra income, harnessing the volatility there and providing you a little bit of extra income to diversify away from North America and give you the income that you need, and both at very attractive fees. International developed EACC at 49 basis points and emerging markets at 65 basis points. And just some quick details on EACC. So really, the target investor profile is looking for that diversification and enhanced income from the developed international markets. What we're finding is some investors are looking to diversify a little bit from North America. Some are taking it from their US exposure that has done extremely well over the last 10 years and take advantage of markets that have not done as well, that have value. And we're also seeing that a lot of people have had cash-like instruments throughout the last few years, and they're becoming more and more comfortable trying to get that invested. And this is a way to diversify as well and get and still get that attractive yield. And with EMCC, the same thing, except for in the emerging markets. Again, looking for that diversification and income from the emerging markets. So Vern, I'm going to pass this back over to you. And I really wanted to get you to touch on how you are active with writing options on the underlying exposure. So again, now our investors understand that the underlying investment is that well-known indice that they're familiar with, and then how are you adding value, or how are you trying to add value with the options program and generating income for them?
So the best way to understand this is to look at the two ways you can manage a covered call fund. You can be active or passive. And I'll walk you through a sort of passive approach of what some firms do. And in essence, what we will do is when the main options expire on the third Friday of the month, some covered call funds will buy back the options they sold a month previously and sell all of their new options on the Friday. And it's a fairly passive, fairly systematic approach in that their option trades occur every third Friday of the month. Now, with our funds being active, we have the flexibility to write before that or after. And we also have the flexibility to write more options or less options, depending on our underlying view of where the core assets are going to be going. So for example, if during, say, March of this year, we were bullish on gold and energy, we could write less options to capture more of that upside. I think earlier I might have called it capital appreciation, but it's in essence capturing more of the upside by either A, writing less options, or B, allowing the underlying to move higher before we sell our options. Mm-hmm. So those are the two big levers that we have actively. It's when we write and how much we write.
Okay. And to summarize, you talked about passive and active. So with our covered call ETFs, the underlying investment is the passive index. That's the well-known, well-followed index. But the active component is you deciding on how much of the portfolio to write on, depending
Correct.
on the market. So
yeah.
and
so
that range is that range
when I say
typically
active
between,
or passive. Mm-hmm. Sorry, go ahead, Jeff.
I said, was that range typically between sort of 30 and 50%?
Okay, so just for clarification, when I say active or passive, I am talking about the options program.
Right. Yeah. Okay.
And second, in terms of the range of how much we write, it's typically between 20 and 50%.
Okay.
For all of the funds.
Right, because as I said, our underlying index is passive, but some some mandates actually then even have a passive option writing strategy, a certain amount, a specific amount on a specific day. That's a passive
Yes.
options writing strategy, where our options writing strategy is active, and that's where you have and you're trying to add value. And you can have that range between, say, 20 and 50% typically,
Correct.
depending
Depending on the
on.
fund, I would say the majority of covered call assets in Canada at the moment are passive.
Okay, good. Good. Okay. And then your views on the opportunity.
So I found this chart interesting because it sort of highlights, if we say for emerging, the funds holds, call it 1,300 different companies in 24 countries, or in developed, it's 21 and just over 700. When you compare, when you compare it to most people's portfolios, they're mostly skewed to that top left corner where it's mostly US CAD.
Mhm.
And the interesting bit is if you look to the first one, the developed, just getting the opportunity to invest in 21 countries and a number of stocks adds an incredible level of diversification to one's
Mhm.
account. And then again, with emerging, what I found interesting about this one in the bottom right corner is you see that over the time period, at the top, we have the dark blue, which was fairly dominant in 1995 and has diminished, the sort of downfall of Brazil during this period.
Mm.
But then afterwards, you see this emergence of the light blue. And, one of the benefits of diversification is being able to have pieces in all of these countries
Mhm.
where the downfall of one isn't the downfall of your portfolio.
Right.
You
And
get that.
there are people looking for specific opportunities within these regions as well. I mean, Japan has come up a lot, and this way you can have pretty large exposure in your international developed EAFE with Japan, and I know India is coming up a lot in emerging markets as well, so that you can have your exposure there without being solely concentrated to one geography.
And
And I
and it,
like the
it
diversification angle. I really like that because I think if you look at the international developed, the EAFE market, you're going to see a lot of different top holdings than you do in the US. There's a lot of healthcare in Europe. There's a lot of consumer discretionary that's big in Europe. Um, and definitely different sector exposures and definitely different top holding, of course, different top holdings, but a lot of different sector exposure, providing that diversification you might be looking for.
and the non I'm looking at the list of countries in developed. I mean, you have everything from Norway to New Zealand to Israel to Hong Kong. I like to think I manage my own personal portfolio fairly thoroughly. I have no time to look at stocks in Hong Kong that could be advantageous to my portfolio. And I think it's fascinating when you have these massive baskets. It's a little bit of a cheat code to get exposure to a lot of things with a little bit of effort. Now, if you go to the next slide, this will touch on the why a little bit. We have the fact that the emerging X developed over time has grown more in terms of real GDP. And, when you consider EM represents roughly 85% of our population on the planet and 42% of our GDP, what's fascinating during this is that it represents 80% of GDP growth. So it's an interesting opportunity in a space that only represents, in essence, 11% market cap of global equities. So beyond the diversification, I think the fact that we get access to potential growth going forward. And then if you go to the next slide, you'll see where we are on each of the individual countries. You'll see what their annualized GDP growth rate is, plotted to the performance. And again, I'll highlight on here, you can see it if you go between 4 and 5 on the bottom up to 6, you'll see the US. But what you'll also see is all of the developed market in dark blue is all skewed lower in terms of growth rate and lower in terms of performance than the emerging country counterparts. So, there were times, and you go back, so I'll just add one more point. There were times, if you look at 2000 to 2010, there was this massive sort of cyclical outperformance that EM had over DM, and then they may have lost part of that advantage in the next decade. But I think it's interesting when you can see when we're in a period again when we turn, it could be an interesting opportunity in the EM space.
Mm-hmm.
Over to you, Jeff.
Yeah, and reasons to consider EACC, covered calls on international developed, or EMCC, covered calls on emerging markets. Again, those diversification benefits for sure. The income opportunity we can try to generate for you within them. But it's really, you're trying to get less volatile exposure to international markets. And historically, a call writing program has dampened the volatility compared to just the underlying index itself. And some money is going there, so it can be an opportunity for new assets or switch away from something else. As I said, money has been moving to international developed and emerging, EAFE and EM, which looks to be either an opportunity to take some profits from US or money getting invested from cash or cash-like investments and trying to capture that yield and having that international markets allocation. And again, just sort of a summary of something I showed earlier, a review of our equity essentials. And now that I have reviewed EMCC and EACC, you see that in the covered call, the second column. So now we have these 4 different ways you can invest in 6 different indices, 5 being geographic and 1 being Canada, equal weight Canadian banks, which is always a large allocation for a lot of investors. So we're going to move on to our premium yield ETFs, which are more focused on government bonds. But before that, I got a question, Vern, on our covered call equity program. Let me ask that quickly right here. In the big index covered call funds, TSX 60, S&P 500, do you only write on the underlying index calls, or do you have the opportunity to write calls on sectors or individual stocks? So how are you providing that coverage?
Okay, so for the TSX 60, we write specifically on the XIUs. So let's be clear, for all of these, we hold the index. We don't hold individual stocks for the index covered call group.
For the geographic
TSX 60.
Yeah.
Pardon me?
For the geographic with the TSX 60, S&P 500. Yeah.
Yeah. And then specifically, again, for the TSX 60, we write options on the XIUs. For the S&P 500 and the NASDAQ, we write options on the big contracts, so the NDX and the SPX.
Right, and very deep options markets on those.
Yeah, very deep, very liquid.
And then another question on that is, does the level of implied volatility affect how much of the long position you write against? If options are expensive, do you write more calls?
It depends on the underlying outlook. Typically, if we're bullish and they're more expensive, we would write less because we could receive enough premium because they're expensive, and we could reduce our coverage on the options so that we could participate more in the upside.
Okay. All right. So ideally, we've shown you there could be opportunities for diversification and income in the international and emerging markets, provided you a couple ideas where you can access that. And we have a lot of different ways. So if you do have questions, please let us know if there's more information on any of those ETFs in that grid of our equity essentials. But we also wanted to focus on our premium yield ETF. So what this is, again, the need for income has been so paramount with the aging population that's been led to the growth of covered call solutions on equity baskets or equity indices. But we saw the opportunity to enhance the income that we're providing on government bonds. And a couple of reasons why that is now. One, the yield on government bonds is high enough now that it's attractive. And there's enough volatility within the yield space that you can then even take that already more attractive yield than it was a few years ago, for sure. It's gone up by 4 or 5%. And then with the extra volatility in there, you can even enhance that yield even further. So this way, we're actually providing more income in the space that you're typically used to getting income from. And we're very well known for our cash leg lineup here at Global X Canada, with a hugely popular lineup and a leader in the space. I always say, know what you own. And with C-bill and U-bill, you're simply getting 0 to 3 month government T-bills rolling for you. So we're managing that for you. And with our cash lineup, cash and ucash.u, you're purely getting deposits with the big six Canadian banks, either in CAD or US dollars. So you know exactly what you're investing in, and there's not a mishmash of money market and commercial paper that some other similar type ETFs might be providing. It's exactly either 0 to 3 month T-bills, Canadian or US, or bank deposits, Canadian or USD, with big six Canadian banks. But the question is, and these are providing approximately 5%. It's a little higher on the US side, a little lower, even a little lower after today, with the Bank of Canada going down to 4.5. So you're sort of in the 4.5 range. But for the sake of this slide, is 5% enough? And it is for some. I mean, hence the reason why there's been such popularity in these ETFs. But are you looking for more? Is it enough? And are you worried that it can and will go lower, just like it did in Canada today, and it did a few months ago? So we were sort of 5-ish in Canada a few months back, and now 2 25 basis point cuts. We're at 4.5. Still a very attractive yield for purely safe investment. But do you see that trend going lower? Are you looking for higher yields? But do you still want the safety of a government bond? And that's the solution that I think we're providing here. And Vern, maybe I'll just have you touch on yields and where you think yields are going first, and then we can explain how we're able to try to provide a little extra income, but yet still have that low risk and that high credit quality.
So I always like to start with this, where we go back in time. In this case, we're going back to 1975 to see what's happened with US rates. And if you look on the far right side, you will see where we are now. We had that initial drop in 2020, and then the steady rise to the pause where we are at the moment. And in determining a view, one approach I like to look at is to see where the market views the direction of rates and where the Fed thinks we're going to go. And if we look at the next slide, what you'll see, you got it there, Jeff? Next slide, please. Yeah, perfect. Is you will see the implied rates based on the Fed funds futures and where they're priced in terms of future rate cuts. And you can see, and I'll explain this chart. If you look at the bar charts, so I'll highlight very specifically the second last bar titled 2024 12/18, and you'll see on the right side of that bar the number 4.6. And the way you read this is the market, in terms of Fed fund futures, have priced in a rate in December of 4.6 versus our current rate of 5.5 or 5.25 to 5.
5.25. Yeah.
Yeah. So it's interesting to see, well, okay, if this is what the market thinks rates will be at the end of the year, and you'll see specifically, if you go to the second bar from the left, the market's priced in a 1/4 point cut for September. So now if we take a look at the next slide, and this is sort of one of my favorite obscure finance slides of all time, the Fed dot plot. Because when you look at it initially, it looks like a child's drawing. But what each of these dots represent is the Fed chairs, each of the Fed members, what their prediction is for the year. So starting at the left side in 2024, what you'll see is 3 rows of orange dots in essence. So you can see of each of the Fed members, they're all pretty close to where they think they're going to be. You know, 4 don't think we're going to get a cut, and a couple think we'll be under 5%. If you look at that, that's, you know, about 40%. And then if you look going forward, if you're curious, for 2025, the spread between where they expect rates to be is up significantly, with one Fed member thinking it'll be under 3% and one member thinking it'll be the same. But you can see the bulk of them have rates at about just over 4%, looking from left to right.
Mhm.
So,
And sorry, go
sorry,
ahead.
go ahead. Yeah. No, go ahead.
I was gonna say you're showing what sort of the market's anticipating, and of course we got a question. You know, what's your view of how much they're going to cut, and by when? And maybe just this year or early
So
next
I'll walk you through one exercise I go to when I'm looking at this. And that is, sorry, I was just looking at the question from Avinash. One of my view is always look at what the market says, look at what the Fed says, digest it and come up with your own view. And one of the ways that I would recommend reading this in terms of interpreting it for yourself is read how it changes over time. Because much like stock charts, now CMT is coming out, much like stock charts can give you some inkling of where they're heading, I believe the rate of change in the dot plot, as well as the rate of change in that Fed funds prediction, gives you glimmers of where we're going. And then additionally, to walk you through this thought exercise, we know Jerome Powell, we're talking US, this is what the question was related to, always talks about 2% interest rates and PCE. So if you look at the signposts, every month we get CPI numbers, we get PPI numbers, we get PCI numbers, and then we'll get a few, is the economy strong or is it weak numbers. How do these two levers, the dots and the Fed funds, react to those numbers? And as those reactions come in, my conviction to the direction and the magnitude of rate cuts increases. So a while ago, I was having a chat with some colleagues and some friends about where rates are going, and I believed we were getting a cut in September before it was clear on the Fed funds. Now, not to talk up my own book or my own perspective, but if you're looking for two measures that are beyond just an individual's idea of where they should go, and you're creating this factor model to determine are rates going up or down and by how much, the two charts that we've shown today should be overweight in determining what your view is. And they are overweight in determining what my view is specifically. So in the US, right now we're looking at a quarter, maybe a half by the end of the year, based on Fed funds and dots. Now I looked at the Fed funds. So that chart that we had, those two charts that we have up are from June 30th. I've looked at them for today because they're updated every day.
Right. So
And
September looks good. And then maybe with the one next after the November, but then you have the election, and then maybe is there one more opportunity before year end?
maybe, yeah. I mean, right now we're looking at maybe one in September. I mean, the one in November is so close to the election that would be surprising. And I want to check historically to see if they've ever done that. And then December. So potentially 3, but at least 1, maybe 2 is how I put it together. And if you hold on 1 second, I will give you one additional piece.
Is there one before September, or is that past?
Pardon me?
Is there another one before September, or is that the next one?
We have a meeting in July, and right now there's a 93% probability rates will be the same. If we look at September, there's a 91% probability we're going to get a cut of a quarter point.
Yeah, right. Okay.
You know, and then once you get to November and December, it's not as definitive given today's numbers.
Right. So then depending on one's views or leading or listening to your ideas on what might happen, you talk to us about sort of the target duration that some of our of this suite and how you can target specific duration and how you can invest in it.
Yeah. So if you look at the yield curve at the moment, Jeff started this conversation with is 5% enough? And what we've done with the Pay series suite of ETFs is we've launched 3, and the 4th we'll be telling you about afterwards. But we've launched in essence 3 different ETFs that focus on 3 different bond durations. And as a result of focusing on 3 durations, they offer 3 different distributions. And we have SPAY, which has a duration of less than 3 years, MPAY, which is between 5 and 10, and LPAY, which is over 10 years duration. And then the new product we're launching, which is PAYS, which is like SPAY in that it has a duration under 3 years, but it's a Canadian dollar product versus SPAY, MPAY, and LPAY, which are US dollar products.
Right. So we're providing different exposures, different solutions based on depending on your view in rates and where you want to be on the duration curve. And the duration meaning sensitivity to interest rates. There can be more volatility. The longer duration you are invested in, the more sensitivity to interest rate moves you have. But these all have the same very high credit quality of the government bonds and offering you that the yield that those government bonds generate, as well as some extra tax efficient yield on top of that from option premium, which we'll talk about. And just so you're aware that volatility can go up a little bit the further you're out on the spectrum of duration, but that also offers the opportunity for even extra yield as well.
Yeah. And then if you switch to the next slide, Jeff, we have a nice summary of all of the premium yield ETFs.
Right. So this shows you the details. So the first column is PAYS, PAYS. That's the ETF ticker. That's the one we just launched. That is the more Canadian version and currency hedged version. So it's got more Canadian Treasuries in it, more Canadian T-bills. It's still, providing lower duration, less than 3 years, sort of 1.5-ish now, and then trying to get you a little extra yield on top of that as well. So it is Canadian hedged, so you don't have to worry or be concerned about currency fluctuations if you are concerned about that, because the other 3, SPAY, and which has a US dollar, which all of them have a US dollar version as well, MPAY and LPAY, offer exposure only to US Treasuries, T-bills, and longer-term Treasuries. They offer you that range of durations you might be looking at, SPAY being less than 3 years, MPAY being in that middle duration, mid-duration between 5 and 10 years, and LPAY being 10 plus years of duration. So the further you go out in duration, the slightly higher yield, but also a little bit more potential volatility based on yield, on movement in rates. And I just want to note that these, if you're not in the US dollar version, if you're in the CAD version, they are not currency hedged. So then you also have exposure to the US dollar currency moves. So if you believe the US dollar is going to strengthen against the Canadian dollar, you can benefit from that within these. Over the long term, if you believe that. And even if you think you're neutral, it's a good way to go. It's just there could be a little bit extra volatility. Sometimes it moves a little bit and it's not the underlying duration or fixed income or option writing. It's just so the currency has moved a little bit. So we want to make investors sure they're aware of that. And if you are concerned about currency, but yet still like this idea of really high credit quality of government bonds, low risk, and an attractive yield, then you would look to PAYS, which is more Canadian and currency hedged. So yeah, you see that risk rating is low across the board, except for low to medium in LPAY. And the only reason for that is just the longer duration. So if rates move, there's some movement in the underlying value. Credit quality is extremely high. So you can get very attractive yields paid out to you on monthly for those budgeting needs at a very attractive fees ranging from 35 to 45 basis points. And you see your treasury exposure on that slide. So a very useful slide summary of how you can invest in this space of government bonds with enhanced yield income with extra income. And then I just said some of the details which I just reviewed. So, focused on capital preservation. That's why you're invested in government bonds. You want that credit quality there. Willingness to take on a modest amount of risk to enhance the income that you can receive from being invested in those. And that's SPAY, MPAY, and LPAY. So Vern,
Yes.
we want to just summarize it with a strategy overview on how you manage the options within these ETFs, options on what are you writing options on, and how are you active within this space. So the investors now understand they're invested in government treasuries, either short T-bills or longer dated treasuries, a combination of the above, and then you're writing options to generate extra income. So what are you writing options on, and how active are you within that program?
All right. If you could actually go to the next slide, Jeff. This next slide will summarize nicely the difference between the portfolios of SPAY, MPAY, and LPAY. And what you can see is for SPAY specifically first at the top left, the fund owns 90% short-term T-bills. And those T-bills are organized in a laddered structure where they come to maturity every few weeks. So the bulk of the return from the underlying in this is coming from T-bills. And then if you look at that little gray section for the 10%, that represents the long-term treasury bonds that we hold in these funds. And typically we hold the ticker TLT. Now, if you look at MPAY, you can see it's 40% long bond, and LPAY it's 80%, which is a split in the portfolio between TLT and BGLT. Now, for all of these funds, if you look at the bottom, you can see there's a red and green section, and what those represent are options that we write on the underlying portfolio. And for SPAY, and for all of them actually, we can sell both calls and puts, and that's the main differentiator between these funds and all other covered call funds that just sell calls. Is the fact that we can sell puts. So for SPAY, when we initially launched these, it was a split about 10% each, 10% calls, 10% puts. MPAY was about 15% each, and LPAY was 20% calls, 20% puts. And if you go to the next slide, we're going to skip over that one. I want to highlight specifically, sorry, Jeff, if you could go to slide 36, I'll go straight into the strategy bits.
Do you see that?
So yeah, perfect. So I want to highlight this specifically. This is one of my favorite slides in this whole deck. And if you can go back to our rates conversation earlier in this presentation, if you think rates are going to come down, bond prices are going to go up. And if bond prices are going to go up, you don't want to sell calls. And the flexibility of this system, or these ETFs, are that we don't have to sell calls to generate income. We can skew more towards puts. And if you go to the next slide, you'll see the impact of this. Typically that red line that you see there is your standard, let's call it 100% covered call, right? The fund owns one thing and they write options on everything that they own. The orange line in between is if you write less than 100%. So typically for the pay series, we're closer to that orange line in representation, maybe a bit steeper. But the beauty of being able to shift from calls, even calls puts, to more puts is that it steepens that risk return profile and makes it more akin to being long the underlying than being long a covered call. And these two slides, I think, summarize the power of how these funds have been structured and the benefits you can get when we can skew and sell puts when bonds are going up because we're not capping the upside.
Right. So great point. Huge differentiator for us over some of the other providers that have also issued covered call solutions on government bonds. So that is the ability to do right calls and puts. So if you believe bond prices are going to go up, you don't want to limit your upside completely with the calls. So you have the ability to use puts as well. So the question is, how do you decide and when do you decide on when you would skew it more to puts?
So we can use history on our side with this one. When we launched these back in October, you'll remember there was a moment of uncertainty whether rates were going to go up and down. And then during the November meeting, the world got optimistic, thinking we were going to get 18 cuts the following year.
7
And
cuts.
you'll see that that was the moment when everything went risk on and stocks went up. And specifically, the underlying for these funds, TLT, went from 89 to 100 in 2 months.
Mm-hmm. Yeah,
And
November, December, big rally in equity and fixed income.
exactly. And when the world feels like we're going to get cuts, there was a very positive reaction from the market in both stocks and the long bond. The decision to switch towards puts will be skewed when the market is clear that we're going to get cuts and we have a rally like we did at the end of the year.
Mm-hmm. Okay, good. And I know we're going a little long, but I've answered quite a few of the questions throughout. So just back quickly to this side, you're really getting the safety and the income that a lot of investors are looking for right now with that high credit rating, that low risk rating, and attractive yields, with some of that even being tax efficient from our option premium. So you're getting any of the income you're getting from the underlying bonds would still be interest income, but anything above that, depending on which one you're in, can be a little bit higher, and that would be in the form of capital gain from option premium. And sort of adjust again. So now introducing pays. That's the new one. We've had SPAY, MPAY, and LPAY since October, and we just launched pays just a couple months ago. And the underlying is C-bill, which is the 0 to 3 months Canadian T-bills, using some TLT that we can write options on, currency hedged, yes, duration less than 3 years, monthly distribution, risk rating low. So for advisors, I always say the risk rating that you want and need for your portfolios, but yet still providing the income that your clients want and need to see in their portfolios. So a little bit of best of both worlds in portfolio construction and providing that income to your clients. And just the details on that, same as SPAY, focus on capital preservation, the willingness to take a modest amount of risk with duration, and yet trying to enhance that income. And on that, I'll take a quick break for a question and said, SPAY or pays, very similar duration and credit quality there. What do you see the downside of that SPAY could be? I would say some of that is currency within SPAY movement, and then just that little bit of duration. But if you want to touch on that.
Yeah, if you could go to slide 38, the last one with the summaries. So to drive home the point on this, SPAY, MPAY, and LPAY are US dollar fixed income. Let's call them covered call, covered put, income generating products. Pays is the Canadian equivalent of SPAY in Canadian dollars, where that 10% position in US Treasuries is hedged. So you have no US dollar exposure. So in comparing PAYS and PAYs, one of the things you need to decide is if you want US dollar exposure or not. The other consideration is because of the hedging program and the rate differential, the distribution on PAYs is slightly lower than the distribution on SPAY.
And that's primarily because the T-bills in Canada are paying slightly less than the T-bills in the US.
Correct.
Okay. And this that shows you that nice summary. And I'm going to come back to that, but and just this here. So again, with pays, this is for if you're still interested in those government bonds, duration less than 3 years, you're not getting much interest rate sensitivity, and it is hedged, as Vern just alluded to. And here's sort of the whole lineup. And I did just get a question on the taxation of these, and I believe I touched on it at the very least. So if the underlying yield, let's look at SPAY.U. So the U.S. Treasury bills are paying just a little over 5. T-bills, 0 to 3 month T-bills are paying around 5 right now. TLT closer to 4. So in that blend, you're getting, say, about 5% in interest income. But if we're targeting a yield of around 7.5%, then you're getting about a third of that yield would be in the form of a capital gain, tax efficient from option premiums. Is that correct, Fern?
Yes.
Okay, and then how are they taxed? And when you're using them in a portfolio construction to hedge, like we are in this case, they are taxed as a capital gain.
Yeah, there's a specific minutia that if you sell puts that are in the money, it becomes more problematic, but I don't sell in the money puts for these funds.
Oh, okay. And then we'll just leave our disclaimer up, and I just got a couple more questions. And then with that, the inevitable question, Vern. Given the likelihood of interest rate cuts, which pay do you think is suitable for risk-averse, medium-term investors?
Risk-averse, medium-term.
I guess that medium-term horizon, I would assume that means.
So I'll walk you through the thought process. If you have low conviction that we're going to get a rate cut, you don't think the underlying is going to go up, and you may not want to accept the volatility of the underlying. So you would skew more towards SPAY, which is majority T-bills, than LPAY, which is with longer duration, which is majority longer bonds. I think the ultimate decision to choose between short duration and long duration depends on your conviction if we will return back to November 1st, 2023. If I had a crystal ball and all the tea leaves read that we're going to go back to a period where everyone thinks we're going to get a lot of cuts, and that's supported by inflation coming the right way, the economy needing it, then I would skew more long duration than short duration because I would get some of the benefit. Now, it depends on the risk profile. Medium risk profile maybe is medium, but it's hard to say clearly because that's a bit ambiguous. But I would say specifically, some people, if you look at whether you're tactical in in the way you're moving between funds or if it's an allocation, tactically is what some people will do is park in SPAY and move to LPAY when they feel strong conviction that the market will shift its perception and feel that we're going to get cuts.
Yeah. You got to factor in where in the rate and in the yield curve rates might move as well. If you believe there's going to be cuts from the Fed or Bank of Canada, that's in the short end, and is that reflected already in the longer end, or do you believe that's got to trend down as well? So to answer sort of this question, which was a risk-averse investor for less volatility, SPAY might be the option. And again, we have to be careful providing advice as we can't without knowing all of the details of
Exactly.
an investor and their client profile and risk tolerances. But SPAY is designed to have less volatility than MPAY and LPAY. But based on your view, Vern, you're thinking there is an opportunity maybe longer in the curve because you believe yields will come down. And that's where you'll see more upside and a higher yield as well.
Well, I will say this. I believe if you look at the last 2 months of last year, when optimism came back to the markets, that is how these funds reacted. There was more torque in the long duration than the short duration.
Right, right. And it's interesting the flows that we see being invested in these ETFs or purchases into these ETFs. We've seen it move around based on sort of views. It was L at first, then S short, and now we are seeing some more medium as midterm MPAY, as people probably just want to sort of be in the belly of the curve to try to take advantage of if a little bit of higher yield that it provides, as well as a little bit more upside potential when yields go down. So the last question we're going to end with here, and I was going to touch on this in our closing, is are we going to post or share this presentation? So everyone who is registered and attended this presentation will receive this webinar and presentation afterwards. We're going to end there because we're at the full hour. So one, I appreciate your attention. And again, I want to thank everyone that's attending this for their support of our firm and our ETFs over the years. We've had a lot of growth with the support of our partners and investors, and we do definitely appreciate that. And that's why we try to hold these and try to add some value and provide some value back so you can help make your investment decisions. So we're very social. Please contact us or look for us on Instagram, Twitter, Facebook, LinkedIn. You can email us at info@globalx.ca, or for the advisors in attendance, you can also reach out to your sales team and ask any question you need. So with that, we're going to end. I believe I answered most, if not all, of the questions that came in throughout or at the end there. So Vern, I want to thank you for your time. Very insightful. A lot going on in the markets. So your insight and thoughts and presentation are really useful and helpful for our investors and ideally their support of our ETF. So thanks everybody, and we're going to end there. So have a great rest of your day.
All right, cheers. Thanks, Jeff.
Thanks, Vern.